took us our screen capture, I guess. And we hope we've sort of fixed it today. Let's see. All right, so this topic is about understanding interest rates, and what I really want you to be able to do, I guess by the end of this week, is that you would be able to calculate the price and the real rate of return for coupon bonds. All right, and I'll explain what coupon bonds are in a little bit. Okay, so as we go towards that goal, I'm going to talk about a couple of concepts. The first is present value, a really, really, really crucial concept for this entire course. The yield to maturity, what's a real interest rate, and then how do we calculate the rate of return, which is actually different from the yield to maturity. It can be sometimes very, very different. Okay? And to do that, we're going to kind of take those concepts and see how they apply to different debt instruments. Right? And I'm going to start with simple loans because I think it's the simplest. Okay? We're not going to do fixed payment loans because they're sort of complicated, but that's covered in your textbook and you can look at it. Let me just remind you, what's a very common fixed payment loan is a mortgage. Okay? And then we'll talk about discount bonds and coupon bonds. What are they, and how do we apply those concepts to those two? All right, so let's start with present value. And I start with this quote. You can think about, after we've talked about what present value is this really the right quote? Okay, but a bird in hand is worth two in the bush. Now, there are two ways to think about the meaning of that quote, but let me put it in terms of money instead, okay? So let me I brought my money here. This is Ichima yen. All right. So let me ask you, would you rather I give this to you right now? Or would you rather wait and have me give it to you next year?
I want it now.
You want it right now? Anybody want it next year? Why? So there are two reasons. What's the number one reason you want it now? The main reason you want it now is what?
You can use it right now.
Oh, is that the main reason? Okay. Okay.
What is the main reason?
Okay. That's not actually, once we look at some data, I don't think that's a good reason to want it right now, that you can use it now. What's the main reason? Anybody else have a different reason for wanting it now? Yeah. Okay, so this is getting at the concept of present value. So if I give you this Ichima yen, what can you do with it? Yeah, so you're not like Koji going to go out and buy something with it, right? You're going to invest it.
That's my second reason.
Is that your second reason? You can get interest on it. Okay, now both of you, I would say the same thing to you that I said to him. Actually, when we look at the data, you might change your mind. Okay, but yeah, this is present value, right? You would rather have it now, invest it, and then what's the advantage of that? You can get some interest next year, right? Is there any other reason you might rather have it now than next year? Yeah. I have forgotten your name. June, sorry.
Well, we don't know if you'll actually give it to us.
Yeah, so that's what I thought would be the first reason, but you all trust me so much. That wasn't the first reason. So the first reason is, of course, in a real experiment, right, you're not really sure, is she really going to, honor that promise and give it to me next year? But suppose that you trust me implicitly, or you have a written contract that's, upheld by law, and you know for sure you can have it today, or you can have it 1 year from now. Okay, so suppose you know for sure. Actually, I just realized, do we have a seating chart for them to sign? Is it okay? Can you go get one quickly? Or?
Yeah,
Okay. That'll help me to be able to call you by name. So suppose you somehow know for sure, so take that out of the picture. You're not worried about whether you really get it today or a year from now. So you know you'll get it. And let me just see a show of hands. Does everybody want it now? Who wants it right now? Okay, is there anybody who wants it a year from now? And can say why? Okay, all right, let's see. So let's come back to that question at the very end of class, if I can time class perfectly. We will have time at the end of class to come back to that and see if you still feel that way, okay? But let's say, so everybody here are sort of being what's probably what economists call rational, and that means operating on full information. You'd rather have it now than a year from now, and the reason is present value, actually, which is what they're saying. They can take it right now and invest it. What is present value? Well, present value is the current worth of a future cash stream. And to use this little example I gave you, the present value, what you all think, is that the present value of Ichimaen next year, you must think it's lower than the present value of Ichimaen now.
But there's deflation going on.
Yes, there is.
So
Oh, actually, no. What was the latest inflation number? What was the latest inflation number? Anybody follow the news? We don't have anybody. Usually I have like one or two people who are following the news. Are you? Who are you pointing to? Claire? Claire, did you see the latest inflation number for Japan? Anybody see? Can anybody look? Anybody have a smartphone or something? What was the latest inflation number for Japan? So this is a very crucial part of trying to determine whether you want this money now or next year. Are we in deflation still? All right, so while some of you are looking that up, just interrupt me if you find it. So what present value does is it allows you to sort of compare the value of different sort of debt instruments, like the ones I mentioned, okay? A simple loan, we could do a fixed payment loan, although it's pretty complicated. You need a special calculator to do that. Coupon bonds and discount bonds. All right, well, let's start with a simple loan, okay? What is a simple loan? Well, it really requires, did you find it? Yeah.
1.7%?
1 point,
Inflation.
what month is that?
April 2nd, 2014.
Oh, okay, so I think I last saw the February number. I don't think,
Oh, yes, it's February 24th.
February 24th, was it 1.7? Yeah, February is 1.5. So I think 1.5,
3 years in pocket, so I'm sorry.
okay. I think 1.5 is the latest sure figure that we have that we can sort of count on. They may have predictions, but the last reported number is 1.5. So if we're no longer in deflation, does that change your answer? Why don't you think about that? Okay. The answer is it depends on some other stuff. Okay. Anyway, let's talk about simple loans first. So what's a simple loan? Well, a simple loan, it just requires the payment of one amount, okay? And that is, it's going to be the principal plus the interest. It's sort of one lump sum, after a period of time. We'll look at 1 year or 2 years, something like that. All right, so here are some terms that are useful when we go into other debt instruments too. Loan principal, what is that? That's the amount. Let's do an example here. I'll be the lender since I have a lot of money up here. Okay. Is anybody willing to be the borrower? Okay. So I'm going to lend a principal amount of Ichimaen to my borrower here. There you go. Okay, and of course I got a contract that's legally binding in exchange for that. So that's the principal, is Ichimaen. Okay? What's the maturity date? That's the date that the loan has to be repaid. And we'll pretend it's a year, but really I'm going to collect it in a few minutes. Okay. Now, related to the maturity date is the term. So that's sort of the length of the loan. So if his loan is due back 1 year from now, then that loan, simple loan, has a term of 1 year. And then, right, I don't just lend that to him and take it back, right? I'm going to require an interest payment. Okay? And that's the cash amount that that borrower has to pay me, the lender, in order to use that principal of Ichimaen. Okay? He has to pay me something back. All right, and so we can calculate from that something that's called the simple interest rate, and that's the interest payment divided by the loan principal. So it's the percentage of the principal that has to be paid as interest. And usually, no matter what the term of the loan, so ours is going to be just for a few minutes, but we usually express that in an annual basis. Okay? All right, and let's do one example first. I wanted to kind of have you talk about a few concepts, do some applications in little groups. And I was thinking 3, 4, 5. So maybe you can see who you might kind of work with around you. You two will either have to be a group of 2 or move, I guess. All right, so think about this question first. maybe you don't need to discuss it with each other. So suppose we have a simple loan. The principal is $100. The maturity date is 1 year from now. What's the loan term? That's the first question. That's real easy, right? What is it?
1 year.
It's 1 year. Okay. The loan term is 1 year. Oops. The interest payment's going to be $10. So if the interest payment is $10, what's the simple interest rate? Anybody back here now? Sorry?
0.01.
Not 0.01. Well, yeah, it is 0.01, but what is that in percent?
1%.
Sorry, 10%. Okay, does everybody agree? Think through it. It's 0.1, it's 10%. You express it in a percent per annum. Okay, what is your name again?
Tomoya.
Tomoya, you're right. Okay. All right, so this is 10% per annum. Now let's go back to Koji's loan. Okay, so I gave him a loan of a principal of ichiman. Okay, and now a year has passed, and I want to collect that ichiman. And if it's a 10% per annum simple interest rate, how much does he have to give back to me? I hope he has it. It doesn't look like he does. So I'm going to send out my thugs to collect. The servicing on this loan is not nice. How much would he have to give me back? Yeah, we're doing dollars, 110. He'd have to give me, though, am I right? Saying, right? There you go. I'll be kind, okay? All right, so this is the principal plus the interest payment. It's a one-time payment. It's a simple loan, okay? I guess really they're kind of not very usual in debt markets, but they're simple, and you can get some of the key concepts from this. All right, so this example reinforces in a way this concept of present value because it shows you that $100 or ichiman today is usually, under normal circumstances, usually it's going to be preferable to the same amount of money a year from now. Oh, my clicker doesn't work back here. Okay, why? And it's the reason that Jonathan and Koji and some of others of you said, because if you had that money today, the $100 or the ichiman, it could be lent out to somebody else, or it could be deposited at whatever is the prevailing interest rate. In our example, it's really high, 10%. You guys have probably never seen that in your lifetimes here in Japan, right? And then it would be worth $110 1 year from now, even more 2 years from now, even more 3 years from now. So any amount of money, whether it's $1 or 100 yen, if it's paid to you 1 year from now, under normal circumstances, okay, it's less valuable than $1 paid to you today. All right, now let me make this very, very simple example more complicated. Why? Because I just want to make it more general, okay? So the present value of any future cash flow is calculated by doing what we call discounting, okay? Discounting the future cash flow by the discount rate. These are two terms that you want to know, discounting and discount rate. Now, what's really hard, though, is setting the right discount rate, okay? So conceptually, what's the discount rate? Conceptually, it's, do you remember the term opportunity cost? It's the opportunity cost of kind of lost interest. So it's the annual interest rate. Now, of course, in real life, there's not the annual interest rate, but there are a bunch of interest rates that kind of move together. And to decide on the discount rate, you sort of think, well, what could I have gotten? What interest rate could I have gotten? Okay, so we'll talk about the interest rate and sort of pretend there's only one. What's the equation for present value? If we wanted to write it in algebra or symbols, this is what it looks like. So PV is present value. It equals the cash flow, so what I'll get later, okay, divided by 1 plus the annual interest rate, you know, the whatever, the discount rate. And this is the numerator, this is the denominator. This denominator is raised to the power of n. So it's the number of years in the future that payment is made. So we're going to take this equation, which is very general, and apply it to some different types of debt instruments. And I want to make sure that you can calculate present value. for different kinds of debt instruments. Okay, so suppose that the current interest rate is 10%. It's unrealistic, but I think that's what they use in your book because math is real easy, right? Okay. If the current interest rate is 10%, what's the present value of $110 1 year from now? Well, I'll just show you this example. You just plug these in, okay? So you'll get $110 1 year from now, and you want to divide it by 1 plus the interest rate, but here we express it as a number, so 10% is 0.1. And then you raise it up to 1 year, and what's the answer? Do you know? This is super easy. Do you know? Nobody who wants to talk knows. What is it? Oh, thank you. $100, yes. So I need to remember your name. What is it again? Miku. Okay. All right, $100. All right, let me give you something a little harder. Calculate the present value of $25,000 to be paid not in 1 year but 2 years. But it's a simple loan, so it's going to be made in one lump sum payment of principal plus interest. And I'll tell you the discount factor or the interest rate is 0.225%. Now this is not that tricky, but there are a lot of ways that you can make mistakes. Okay, I'm going to let you work on that with whoever you're sitting near. All right. So what equation do you use to figure that out? Do you know? Use the same one. What equation would you use? Can anybody write down the equation? What's the equation we would use to figure this out? Does anybody have it? The one that we just saw, yeah. Yeah, I think so. That one, okay? You want to use that equation and figure out the present value of a 25,000. Oh, it's not dollars. Sorry, it's smaller. It's only Nimango Sen because it's in yen. Sorry, 25,000 yen to be paid in 2 years. If the interest rate, now look at that interest rate, it's very low. Think about what it is in a number, okay? Take just a minute or two and talk to who's sitting around you and see if you can give me an answer. Who can actually figure it out? I think you need a computer, or what you're not likely to have a financial calculator. Oh, you guys can do it on your smartphones, okay. So if you don't have a smartphone or a computer, just write down the equation. What numbers go where? Does anybody think they got it? No. Sorry? Yes. Okay, somebody got it. See if you got this number. Oh. I meant to show you this before. That would have made it a lot easier, but somebody got it without this. So this is what you should have had. Okay, you should put, this is where you put things. Did you get it?
I see.
Do you see? Okay. I mean, this is easy to do. With Japanese interest rates that are so low, if you use realistic interest rates, it's very easy to get the number wrong. Okay? Okay, so don't forget that part. Now, does some of you have a different answer? That's the answer, if you round up. Okay. All right, so in this case, even though the interest rate is super, super low, it's less than 1%, it's less than 0.5%, it's a realistic number for Japan recently. Still, we'd rather have that 25,000 yen today rather than in 2 years, because in 2 years it's worth, not that much less, but a little less because of discounting. Does everybody get this? Does anybody have a question? All right, well, if you really all have this, let's move on to the next kind of concept. So this is simple loans and present value. Now let's talk about yield to maturity. All right. I don't know. In words, I don't think this is super clear, but we'll do some examples. What's the yield to maturity? The yield to maturity is the interest rate that equates today's value with the present value of all future payments. It may not seem to you right now that you would care about this, but you do. If you're talking about pricing bonds, you care about this concept a lot, the yield to maturity. Okay? So the yield to maturity is also the rate of return. Not always, but in some special cases, it's the rate of return if a bond is held to maturity. So you want to be able to calculate that because you want to know if I buy this bond and I actually hold it to maturity, what's the yield? What's the yield on that bond? Now, sometimes the yield is different than the rate of return. We'll talk about that later. But first, you want to be able to calculate the yield. Okay? But let's start with a simple loan. Okay. So what is the yield to maturity of a simple loan of $100 to be repaid with an interest payment of $10 in 1 year's time? Actually, you already know that. Okay. But let me show you how you would do it. So the yield to maturity, which we're going to use an I, okay, it equates today's value of $100 with the present value of all future payments. What are my future payments? Well, my future payments are the $100 principal plus the $10 interest payment. That's what the future payments are. This is a simple loan. So there's not a lot of future payments. There's just one. Is that okay? So we're setting $100 right there equal to the future payments, which is $110. And we want to figure out, well, what is that I? And we want to know that because that I shows us the yield to maturity. So actually, you already know the answer. Do you remember? Yes. Is that what you said, 10%? Yes. Okay, so it's 10%. And here's why. Here's how you do it algebraically, right? But you already knew it because we already did this example. Okay, so what does this show you? This shows you something that might be interesting. For simple loans, the simple interest rate equals the yield to maturity. And what is the yield to maturity again? It's the interest rate that equates today's value with the present value of all future payments. So for simple loans, it's sort of easy to figure out. All right, now let's take these two concepts of present value and yield to maturity and look at how we apply them to bonds. We're going to look at discount bonds and then coupon bonds. Okay, so what are they, first of all? Do you know what they are? What's a discount bond? A discount bond is a bond, it's usually a short-term, actually, I think these are called savings bonds is the slang for them. Has any of you who are American, maybe you got these, have you gotten these as a gift before? I used to get them all the time for graduations. Maybe that's it. Graduations. Anybody's gotten one as a gift? No? Okay. Well, they work like this. They don't pay out any interest, okay? They're sold at what we call a discounted price. It's below the face value, or what bond traders call the par value. It's below that. They don't pay any interest, but the face value or the par value, which is what you can get when you turn it in, is higher than the purchase price. Okay? Let me show you an example. I guess they don't I've never had a Japanese student who said that they got these. Have has anybody gotten these who's Japanese, a Japanese equivalent of this? Okay, I haven't heard of that, so maybe they're not so common. All right, so look at this one. This is a real $1,000 savings bond. Okay. So you see it says on here $1,000. Okay. What is that in yen? That's roughly like 10,000 yen, right? That's a lot. Would you like to have that? You'd like to have that probably, right? All right, so imagine, what is your name again?
Yusuke.
Yusuke. Okay, so Yusuke gets this as a graduation gift, okay? When he graduates from high school, let's say. So he got that a little while ago, okay? Now, when you get this as a high school student, it might look like a lot of money, right? You open that up, wow, $1,000, okay? And you say thank you and you get all excited. But then you learn how these work. Well, this may not mature for like 10 years or 20 years, all right? So he has to hold on to this for 10 or 20 years, and when it matures, then he can go to the bank, right? And he can give me this bond, and they'll actually, here's how it really works, is they really look it up, when was it issued, and you can get it, you can hold on to it longer usually and get some more money. But anyway, then they'll say, okay, so you held it to maturity, there's your $1,000, okay? And so then he really does get $1,000, but he gets it sometime later. All right, now let's think about a person who wants to buy this. Let me give you, your name is Momo, right?
Yeah.
How much do you have there?
Probably like 70,000 or no, more. That's Jumayan.
Is it Jumayan? Let me take one away then. So now it's Qmayan, right?
Yeah.
Nope, now it's Hachi. Okay, Q. There's Q. Okay, so she wants to buy one of these for her, I don't know, niece or something, okay? All right, so you go to the bank, I'm the bank, and you want a 1,000. Let me see what were the terms I wanted to use. Hold on. Okay, she wants to buy a gift for her niece who's graduating from high school or something, okay? And she wants to buy a $1,000 savings bond that matures. And she's not going to make her niece wait for 10 years like Yusuke had to. She's going to say 1 year, okay? And I'll say, all right, I look it up. The price of that is going to be $900. So it's almost $1,000, but not quite, okay? So there you go. And I'll take your $900. All right, and then you give it to, maybe not your niece, but your friend over there. Okay, your friend holds it for 1 year, and then she takes it to the bank, and she wants to trade it in. She wants to redeem it, and she gives me this. And because she waited till maturity, she gets not $900, but she gets $1,000. Okay, you see how it worked? So it's purchased, what's the face value or the par value here? It's $1,000. And the purchase price was only $900. It's below the face value. That's why it's called a discount bond. She bought it at a discount of $100, okay? But there's no interest payment or anything. It's just a one-time thing. You trade it in and you get the face value. That's how they work. Yeah.
What's the point of the government in publishing these kinds of bonds?
They're borrowing money from the purchaser. So Momo, who bought it for, oh dear, Sophia, right? Momo made a loan to the government in a sense for a year.
Are there other kinds of bonds than this? Since it's called a discount bond, it means there's other kinds of bonds, right? Or like, how are they different?
Yeah. The other kind of bond that we'll talk about is a coupon bond. Is that what you mean?
Yes.
So we'll come to that in a minute. And that's probably more common in the sense that that's what corporations issue. Okay. All right, but let's just make sure we've got this one first. Okay. So using this present value equation, make sure that you could calculate the yield to maturity, okay, of a 1-year U.S. Treasury bill, which pays a face value of $1,000 in 1 year's time if the current discounted purchase price is $900. So just calculate the yield to maturity of that transaction, that bond that Momo just bought. Okay? So remember that you use this equation. Now in this case, the present value is the discounted price. All right, and the face value, or the future cash flow, is what Sophia can trade it in for 1 year from now. All right? And you want to figure out, how many years are we talking? 1. And you want to figure out this. Do you know the answer, kind of? Take a minute and see if you can get it. What equation do you want? Even if you don't have a calculator or something, maybe you can write the equation. So you want to do that, right? And figure out I. And what is I exactly for those of you with the calculator, or approximately for those of you without one? Do you know what it is again? 11%. Yeah, 11%. I put 11.1, but is the seating chart done? Oh, there we go. Still going back here? Okay. So 11%. Now, most discount bonds are short-term bonds. That means that they mature in a year or less. Most of them are short-term. So in general, for a discount bond, you can use this equation. The yield to maturity equals face value minus the purchase price divided by the purchase price, which in this case is 11%. Okay. All right, now let's talk about coupon bonds. So a coupon bond, I think we talked about this briefly when we were discussing different kinds of financial instruments. A coupon bond is, again, all the things we're talking about are debt obligations, so this is an IOU. Okay, it entitles the owner of the bond to a fixed interest payment, which we call a coupon payment. That's how they came to be called coupon bonds. And usually it's every year. You get that every year until the maturity date. Then on maturity date, you also get some specified face value or par value that's repaid. So U.S. Treasury bonds that are intermediate or long-term, so they're longer than a year, or corporate bonds are the biggest example, are the most common examples of coupon bonds. All right, so try this. Let me show you a coupon bond here. All right, I've got a bond here. It's a McDonald's bond. Okay, it's a corporate bond issued by McDonald's, and it's a coupon bond. I'll take that, thanks. All right. Its value is Jumayan. Let me give you a little information about it. It has 10 years to maturity, and it pays yearly coupon payments of Ichimayan. Does anybody want to buy this? If anybody did, I would ask you how much you're willing to pay for it. Okay, we have a buyer. How much are you willing to pay for that?
So Ichimayan per year.
It pays Ichimayan per year.
Is that the coupon payment?
That's the coupon payment. Why doesn't everybody try to help her out? What should she be willing to pay for that bond? So it pays a face value, Jumayan, and it pays a coupon payment annually of Ichimayan.
And it goes for 10 years.
And it's a 10-year coupon bond. So what price should she be willing to pay? Can you try? I think it's not that easy or straightforward. Does anybody think they know? Well, let's do an example first and then come back to this question, okay? Try this example first with dollars, okay? What would be the price And that should be the price she's willing to pay for hers, okay? Equivalent question. What would be the price of this bond, which is a little bit different, but it's in dollars. It's very similar. Okay, it's a $1,000 face value bond with 10 years to maturity and yearly coupon payments of $100. So it's a very similar bond, depending on what happens to interest rates. Okay, well, what should be the price? Conceptually speaking, what should be the price? The price should be, all right, this is what you want to be able to do by the end of this class, maybe, the end of this week. If you master this topic, you will know how to price this bond. You want to price it at its present value. You want to price it as its present value. The price should be the present value. Well, how do we figure out the present value? Well, we have to take that equation we've been working with, but we have to expand it out n years. What's n in this case? 10. We have to expand it out 10 years. So you have to write down that equation and figure it out over 10 years. Okay, now first of all, let's figure out, oh, we already know. We know what the coupon payment is, right? So we can plug that in. We want to figure out P, right? And we know what the coupon payment is. I just told you it's $100 every year. So what you really need to be able to figure that out, and this is what makes pricing bonds so hard or difficult to do accurately. What you really need to do is you need to know the discount rate, right? And you may even think the discount rate's maybe not the same in each year. I've written it so it's the same in each year, and let's do that because otherwise it's going to be a nightmare, right? But let's assume there's one interest rate, and we think that interest rate will prevail for 10 years. Okay, of course in reality they might change, and I'll come back to that in a few minutes. Okay, but you really, to figure this out, you need to know I. All right, so let's do a different example. Let's try this one. Okay, so to really know what price this would sell for, what its present value is, we need to know the discount rate. Okay, try this. What would be the price of a 10% coupon bond with a $1,000 face value? This time it only has 8 years to maturity. And we know it has a yield to maturity of 12.25%. Okay, well, conceptually speaking, this bond should also be priced at its what? Present value. We should price it at its present value. What is that? It's that mess with n equal to 10. Okay, now to calculate the present value, we need to know the coupon payments. What are the coupon payments on this bond? 100. Yes, yes. The coupon payment is the coupon rate times the face value, and so in this case I only told you that the coupon rate was 10%. So 10% of a $1,000 face value is $100, so the coupon payment that you're going to get every year is $100. All right? So we want to put $100 in place of which letter in this equation? The C, right? What goes in place of the F? Do you know? 1,000. And what goes in place of the I? 12.25% is what I think I said. Okay. So it looks like that. Would you know how to do that in Excel? You wouldn't believe what I used to make students in this class do. I used to make them do a lot of spreadsheets like that. Would you be able to do that in Excel? Okay. All right. Does anybody know what it is by chance? What is the price of this? No idea? Maybe that would take too long. All right, I'll tell you the answer. It would be, not quite $900, but a little bit less. Okay? A little bit less. Is it in there? I didn't know that. All right. Okay. So that's the price it would sell for. All right, that's the present value of that bond. All right, and try this. For this one, you're going to need to have internet access, okay? What's the yield to maturity? The yield to maturity is which letter in the equation? It's the lowercase I, okay? What's the yield to maturity of a 10% coupon bond with a $1,000 face value, 8 years to maturity, and a current price of $889.20? You already know the answer, right? Because we just did it. What's the answer? 12.25%. Good. Okay. But can you please, if you have it, check this link. Look up MoneyChimp bond yield calculator. Okay? Or look over the shoulder of somebody sitting near you who has that. Okay, and let me try to show you. It's called MoneyChimp. Okay, so what do we want to do again? We want to figure out the yield to maturity, okay, of a $1,000 face value bond. Face value is the same as a par value. Okay, so it's already in there. That's the default they set. It has how many years to maturity? 8. And a current price we said of $889, and let's see if it'll take cents, 20 cents. Okay, now, and so this bond yield calculator should tell us we need to know the coupon rate. What's the coupon rate? Do you remember what it was? 10. Okay. All right, so it gave us the right answer, right? We already knew this was the answer. What I want to point out from this, first of all, I just want you to know about this tool so you can use it if you want to. Because figuring out the yield to maturity is really complicated, right? But it also tells us this thing called current yield. Okay? And what is that? Okay. So we got the yield to maturity. It also gave us something called the current yield. Well, the current yield, this is a good concept to know. The current yield is pretty easy to calculate, even in your head. And the other reason it's good, not just that it's easy, but it's a good approximation to the yield to maturity. And the longer term the bond, the better, closer approximation it is. So especially for really long-term bonds, it's a very good approximation to the yield to maturity. And it's something you can kind of do in your head. All right, it's C over P. So in our example, the current yield was 11.25% if we round it up. And the yield to maturity was like 12 something, right? So it was pretty close. It was only an 8-year bond though. So if we were talking like a 10, 20, or 30-year bond, they would be a lot closer, the current yield and yield to maturity. The current yield is something that I think most bond traders can kind of do in their heads pretty quickly. Nobody can figure out the real yield to maturity quickly in their heads, right? You could have a program that would figure it out quickly for you, but.
So on the final exam, can we use this website to calculate, or should we be able to do it by manually?
Well, actually, I didn't write the final exam yet, but what I would want you to know is I would want you to know the equation for figuring it out, and we won't be able to take it in a room where you have access to Excel or the internet, so I probably wouldn't ask you to do something that's really hard to figure it out. But what I want you to know is the concept, not whether you make a math mistake, the concept. Okay, let me give you this table. Those of you who have your book, can you help me, Nyam? 1, 2. Look at table 3.1, okay, which is here. I hope it's still 3.1. And actually, don't look in your book, because I don't know if it'll say the answer. Try to do this without looking in your book. If you read the book, see if you can remember. If not, see if you can figure it out. What does this table show us? Okay. How many of these we have? Probably just 6? 7? Okay. All right, so there's 1, 2, 3, 4, 5, 6. Maybe we need some more copies of stuff. Actually, I'm sorry, but can I ask you guys to move maybe over here, and you can share, 4 can share one. Okay. Can we have you 4 share one? And you 1, 2, 3, 4, maybe 6 even can share one. You back here share one. Okay. You back here share one. Actually, An, you could join these, or Miku. One of you could join with these guys if you want. Okay. How about you 4 and let Wei join you? All right, and you 4. And you 4. All right, what do you observe from this table? I'm looking for 3 things, but maybe you find more. It's okay for now. All right, which group's got 1 thing? What do you guys got? Okay, let's try somebody. Who has 1 thing? Did you raise your hand, Yoko? Who can tell me 1 thing from this table? Anybody who has not spoken or is not a graduate student? No. Anybody else? Okay, Dana.
If face value and the price of the bond is the same, interest rate and yield to maturity is the same.
Okay, say it one more time.
If the face value equals if the price of the bond equals the face value,
Mm.
the coupon rate for the interest rate on coupon bonds and yield to maturity equals.
Okay, here's how I would say that. When the bond is priced at par value, so you say when the bond's at par, what's the yield to maturity? It's the same as the coupon rate. I'll come back to that in a minute. Did you have something else?
If the price of the bond increases, the yield to maturity decreases.
Yes. So from that par value, if it's priced above par value, then the yield to maturity decreases.
And vice versa.
Oh, actually, it doesn't matter if it's a price level or not. They're just negatively correlated, right? That's the first point we want to notice. So I hope you all noticed that right away. Price and yield, negatively related. If you remember one thing from this entire course, and if you remember one thing 10 years from now when you're doing something maybe completely different, please remember that the price of a bond and the yield of a bond move in opposite directions, okay? Actually, some of you will make a mistake on the exam about that. They move in opposite directions. They are negatively related. When price goes up, well, okay, let's start at the top. As the price falls, the yield to maturity rises. Or we could start from the bottom. As the price rises, the yield to maturity falls. That's the number one most important thing to remember, and one of the key things I would say from the course that you want to understand. You can just memorize it, but you also know it from the present value equation. I'll come back to that. The second one is the one that Raina said. When the bond is priced at par value, when it's at par, okay, what's the yield? It's 10%. What's special about 10%? Well, that's the coupon rate for this bond, okay? So when the bond is priced at par, the yield to maturity is the coupon rate. All right, and then if the price of the bond is lower than par, if it's below par, what happens to the yield? Well, it goes up, right? So it's higher than the coupon rate. Okay, these are three general things that you can tell from this one. Now let's kind of confirm these principles by looking at JGBs, okay? I think you may need a bond calculator to do this one. Okay. So calculate the yield to maturity, and I made it low. It's 1%. We're in Japan after all, okay? A 1% coupon rate JGB. It matures in 15 years. It has a par value kind of similar to $1,000. It's Jumayen. Okay. And I'm going to show you, well, on this paper I'm giving out, I have different prices. Okay. So imagine you see it selling for different prices. See if you can calculate. You can't calculate it. See if you can look up and use the MoneyChimp or some other bond calculator to figure out the yield to maturity. All right. But first, what do we need to know? Do you know what the coupon payment is? What is it? What's the coupon payment? How much do you get every year for this bond? Are you excited about it? It's not much. It's only 1,000 yen. So it's not much. You get that every year. That's your coupon payment every year. Because the coupon payment's really low. Because the coupon rate's really low. All right, so you know the coupon payment, so figure this out. The current yield and the yield to maturity, and then think about it. Did it confirm the principles that we said? Or is it different?
Is there some
All Oops.
Yeah, like that chunk. No, not like that. That here. It's like the higher bond, lower interest. What we need to do.
Wait, so Professor,
Yeah.
what's the logic behind the price of the bond and the yield to maturity being negatively correlated?
Let me see if I have a slide coming up on that. Well, I think I do, but I can't find it right now. Okay. Yeah, you don't have to ask. Would you say price and yield?
Yeah, I'm sorry, price of the bond and the yield to maturity, what's the logic behind that being negatively correlated?
So the price is the present value of the bond. And what is that? Well, that's some kind of cash flow. And in the case of a coupon bond, it's a little bit complicated, right? You have your coupon payment. In every year. What is this one, 10 years? 15? So just mathematically, they have to be.
Right. Because if you have a more expensive bond, then the receipt would be a higher amount than if you had a less expensive bond. Because the coupon rate is a percentage.
Well, usually, you can calculate, I could give you a problem to figure out any of these, but usually, here's what you're given. Well, how does it work? Usually, this is given. And you know the coupon rate or the coupon payment's the same thing, and you know the face value. And you make a decision about whether to buy the bond or not. Now, you may be given this. Okay. And so what you really want to know is, well, the yield, and do I think that's good or bad? And how do you decide whether it's good or bad? Well, you have your own thoughts about what the discount rate will be. What's your opportunity cost? What else could you be investing in and what rate could you be getting? And you compare the yield to that. So usually you're given this and this and that, and you make a decision. Even if you're not given this, if it's like an auction, then people are figuring this out and deciding what to bid.
So because the price of bond is the actual amount of the future in today's terms, you want a bond that gives you a higher price value.
A higher what?
You want to buy a bond that gives you a higher price value. Like a higher price value.
No. You want to buy a bond that has a high rate of return. And the rate of return is very related to the yield to maturity.
Yield to maturity, okay.
So you kind of want a high yield to maturity, but it's a little more complicated than that. You care about the yield.
Right. So, like, let's say for these ones, like, for the ones with the higher yield, the price of the bond is low, which means a 10% coupon rate, let's say for this one, is only $80 compared to $120 for this one.
Yeah. And of course, if I'm a bond trader, I want to buy a low price bond.
Right.
Just like anything else. I want to buy the low price so I can get a high
But why
yield.
would anyone buy a high price bond? If the yield to maturity is what we were really interested in, but the yield to maturity is low if you buy a high price bond.
It's rare that you'll have a choice of bonds with the same exact terms but different prices. So what really happens is it's like an auction or any other kind of market. There's supply and demand, and it settles on an equilibrium price. But the equilibrium price depends on, are these high or low? Well, of course, you'd rather have 13 than 7.
Yeah.
But suppose you only have one choice. Suppose equilibrium settles here.
Okay.
Is a yield to maturity of 10%, is that good or bad? Do you want to buy it or not? Well, you don't know unless you know
The other opportunity.
what interest rates will be for the next 15 years. If you're in Japan, I think that sounds like a good idea. Because I guess rates wouldn't go over 10% in the next 15 years.
So we're not calculating whether or not what bond we should be buying. We're just calculating like this isn't the way you calculate what bonds you want to buy. By calculating.
Well, it is the way you calculate what bid you would make.
Okay.
So you decide. It's a different question, and that's not what you're doing right here.
Yeah. Right. Yeah.
Right.
I just
Okay.
realized.
But in reality, you would want to decide: is that a good price or not? How do you decide it's a good price? Is it the yield that I think I need to get or not? Is that yield above my opportunity cost in a sense, my alternative options? Did you guys get yours filled in? Okay. Okay, so most of you have this filled in. See if your numbers are the same as mine. Is that what you have? Yeah? Good. Okay. All right, so let's check.
The higher the price of the bond, the higher.
Let's check this one first. Are price and yield negatively related? Are price and yield negatively related? Yes. Are they?
What we did is just to change to dollar. Yeah, right. So we got the different.
Oh, you got a different answer?
Yeah.
Well, we did it just like we neglected the dollar.
Oh. Yeah, that's okay. That's okay. Okay. Did you all get the right answer? No. Yeah? Okay, finally, good. Okay, so take a minute and look at this. Are yield and price negatively related? Yes, they are. Why are they? There are different ways to think about that. One is you just calculated and that came out and it's true. But conceptually, here's another way to think about it. Why is that always true? Let me show you this, because Claire asked a question about this. Huh. All right, how's this work? Here we go. The price of the bond, the equilibrium price that the market settles on, should be the present value of the bond. What's the present value of the bond? Well, it's the discounted future cash flow, which for a coupon bond is all your coupon payments every year, plus that face value or par value that you get at the end. All right, where's the yield to maturity? It's this I. All right, so the way I remember it that's easier is just mathematically this must be true, right? They're inversely related because this is in the denominator. That's one way. But another way to think about it is that price and yield are negatively related because if you're able to buy a bond, if you're buying a bond, you want to buy it at a lower price, right? If you're able to buy it at a lower price, you're going to get a higher yield, all other things being equal. That kind of makes sense, right? So those are two ways to remember this basic concept. All right, so that's true for JGBs. How about point 2? When a bond is at par or face value, the yield to maturity equals the coupon rate. Is that true? Yes. Okay? So if this bond were selling at par, if it were priced at par, the yield to maturity is 1%, which is the same as the coupon rate. And how about the third point? When the yield the yield is greater than the coupon rate when the bond is priced below par value. And that's for the same reason I just said. If you get a good deal and you're able to buy it at a low price, right, you get a high yield. It might even be higher than the coupon rate. And you see here we're dealing with a 15-year bond. The current yield is a little bit better at approximating the yield to maturity than it was in the case of the 8-year bond. It's a little bit better. Okay. All right, so here was the slide I was thinking of. An easy way to remember that the value of a bond and the yield to maturity are negatively related is that if that little I increases, then the present value has to be lower. So the bond has to be sold at a lower price. Okay? Now, here's the thing. If you want to make investment decisions, actually you need to know more than even this. What do you need to know? You need to know what we call the rate of return. What is the rate of return? The rate of return is the gain or loss on an investment over a specific period of time. Now, it can be different from the yield to maturity if what happens? Do you know? Do any of you know? It can be very, very different if the interest rate changes. Why? Well, if the interest rate changes, so suppose we bought this bond and we held it for 1 year, and then all of a sudden next year interest rates double. Well, when interest rates double, the present value of that bond all of a sudden changes a lot. Okay? So interest rate changes change the present value, and that means they change the price, the market price of it. Okay? So if there are interest rate changes while you're holding on to that bond or after you've bought it, then the rate of return can actually be very different from the yield to maturity because you get into capital gains losses from the change in price. So let's look at that. Okay? So the rate of return, or the gain or loss of an investment over a specific period of time, is the payments to the owner of a security, so it's what we already figured out, okay, plus the change in its value, and it's expressed as a fraction of its purchase price. So it looks like this. So the rate of return is here's your capital gains change, the change in the price. That may not happen, but it will happen if there's an interest rate change. Okay? And you want to add that to C over P, which is the current yield. Okay? So usually we write it I plus G. I sub C plus G. Where I sub C is the current yield and G is the capital gains. Capital gains can be a loss or it can be a gain from changes in price. All right, so try this. Calculate the rate of return on a JGB with, again, a 1% coupon rate. Again, a par value of, that should be, 100,000 yen. It matures in 15 years, but now I put in a change. So it's the same as what you just did, but now we put in a change. At the end of 1 year, you buy it and you hold on to it for 1 year. And then all of a sudden, the bond is sold for 120,000. Okay, well, here's the equation you would use. Oops, there's the equation you would use. Okay. All right, we calculated earlier that the current yield, in this case, it's exactly the same as the yield to maturity. Okay, but it's an approximation. Is 1%. Okay. But the rate of return is very, very different. Maybe you already knew that from the example. The rate of return also needs to take into account this new information that after 1 year you can sell it for this much higher price all of a sudden. Okay? And you don't have to keep bonds to maturity. You can resell them. You can sell them. Okay? So at the end of 1 year, that 15-year bond is sold for 120,000 yen. And this affects the investor's capital gain, or in this case it is a big gain, from the change in the price of the bond. So the capital gain is huge, 20%. And to really get the rate of return, we need to add those up. And it's big, and you can see that in this example, it's really, 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 really driven by the capital gains change, right? Okay, now why would that happen? Why would the price of a bond suddenly change? You know, I've got a 15-year bond, and all of a sudden, 1 year after I bought it, the market price of it changes all of a sudden. Why would that be? Well, that would probably be because the interest rate changed. So remember that the price of the bond is what the market thinks is the present value of the future stream of income that it represents. So your 15-year bond is still paying that coupon payment every year plus the face value at the end. And all of a sudden, the present value of that stream of money has changed a lot. Why would that happen? Well, nothing up here has changed, but something here changed in year 2. Okay? So the interest rate changed a lot. So when interest rates, or what we're using as the discount rate for the future stream of payments, changes, the price of the bond will change. And you remember, this is now the 3rd time I'm saying it. Bond prices and interest rates, or yields, move in opposite directions. So when interest rates rise, the bond price falls. If our bond price went up from 100,000 yen to 120,000 yen, what's that mean happened to interest rates? They fell. Okay. All right, let me give you another table and have you think about that. And then, oh, sorry, we won't get outside today. I did my best. All right, take a look at this table and see what kind of general principles you can gather from this. Let me turn the PowerPoint too. Did I give every group something? Okay. So what do you see here? Take a minute and look at it. Even what I wrote up there, in a sense, you have the answer, but think it through. Does that make sense to you, what I wrote up there? So table 2 of chapter 4 in your text shows that when interest rates rise, in this example they doubled from 10 to 20%, rates of return can become quite negative due to capital gains losses. Now, doubling of the interest rate would be really shocking, but that's happened in recent history in both Japan and the US. All right, so on the bottom is a 1-year bond. The top is a 30-year bond. They all have the same initial current yield. They all have the same initial price. What happens to the price of that bond next year? Well, so for a 1-year bond, it doesn't change. It's been held to maturity. But the rise, or not just the rise, the doubling, the massive rise, the doubling of interest rates really affects the present value of any bond that has a maturity longer than 1 year. that had a maturity of longer than 1 year. It affects which ones the most? Yeah, it affects the 30-year. The longer term the bond, the more it's affected by the change in the interest rates. I think I gave you the answer. Anyway. Okay. So the only bond whose return equals yield, the only bond whose rate of return equals the initial current yield is the bond who was held to maturity, or whose maturity equals the holding period, and that's the 1-year bond. For bonds that have a maturity longer than 1 year, the doubling of the interest rates reduces the price, and by more and more and more and more and more. The longer the maturity, the greater the price change, and therefore the longer the maturity, the more the rate of return changes with the change of interest rates, right? See that too? And the main point, even a bond that had a high initial interest rate, 10% would be pretty high in our world here. It can have a very negative return if there is a huge change in interest rates before it matures. Okay, so this is how sometimes the rate of return on a bond might be a little different than the yield to maturity. Or not a little different, sometimes it can be extremely different. Okay, so in general, prices and returns are more volatile for long-term bonds. This is also kind of a key concept. Long-term bonds have more interest rate risk. If you buy a 30-year bond, right, there's more risk that interest rates will change from when you bought it to when it matures. Longer-term bonds have higher interest rate risk. And there's no interest rate risk for a bond whose maturity equals the holding period. Now, number 2, if you think about it really deeply, does anybody have a question about that? Yeah.
Is this just that you lose in terms of present value, like you physically get all the money back, it's just that in terms of present value you lose some?
Not just in terms of present value wouldn't be the term I would use, but right. You can avoid, so here's a question I would expect from somebody who really, really understood all this. So were some of you thinking this? You would think, well, if I want to avoid losses on my long-term bond because of interest rate changes, what can I do? Oh, well, you could just buy 1-year bonds. But suppose you already bought a 30-year. You already bought a 30-year bond. Interest rates go up, which is the only direction they can go pretty much. Yeah.
You say, you sign on the contract, you say we're going to pay with the interest rate of that time when we sign the contract.
Get a variable interest rate coupon bond? I don't think people would tell you that. So you can't do that. Let's say you can't do that.
Can't do that?
You might want to do that, but yes. Now, if you sell it before it matures, then you're going to get a loss.
Okay.
So here's the question I expect, which I think is kind of what you're asking. Well, I just won't sell it. I'll just keep it for those 30 years, and then I won't have a capital gain loss. And it's true, you wouldn't. You wouldn't really have a capital gain loss in, what did you call it, like real terms. Yeah. You don't literally like get a price lower than what you paid. But you're only fooling yourself because you have lost out on the opportunity cost of investing out 20% instead of 10%. So you can do that, and maybe it helps you sleep at night, but it's like an ostrich putting its head in the sand. Like, you are still losing money because you still have your money tied up in something that, yeah, maybe the way you said it's okay, the present value has fallen. But you don't have to realize them. That's the thing. They can be what we call latent. Accountants sometimes call it latent. Like, you can just, banks love to do this, right? You're making losses, but you just sort of leave them there on your book and just sort of ignore them for a little while, and you don't really do the trade, so you don't realize the losses. but you're having an opportunity cost loss. So it's still there. Did that make sense? Okay. Where'd I put my stuff? We have to cancel class. Here, okay.
So why does everyone buy a long-term bond instead of
Well, we'll come to that next week. Next week you might one of the things you will probably notice next week, we'll look at some data, is that long-term bonds tend to pay higher yields to reimburse you for the fact that you're taking on more interest rate risk. Yeah, they tend to pay more. So we'll do this example like Momo was saying, why don't I just buy 1-year bonds for 30 years and we'll compare which would be the better deal. Yeah.
About number 2, does the maturity equal the holding period? Like, what's the difference?
The holding period is how long you hold it before you sell it, and the maturity is how long till you get that face value payment. So you don't have to hold it for 30 years. In fact, often people don't. You sell it. All right, let me give you one last question that's kind of hard. Well, it's a little bit harder than the ones you did so far, but I think it's doable. Okay. All right, try this for JGBs, okay? So I want you to calculate the 1-year rate of return, not the yield to maturity, the rate of return on a 1% coupon rate JGB. It has an initial price of 100,000 yen, but now we're going to say the interest rate doubles in Japan. All right, but it's not from 10 to 20, it's from 1 to 2. Okay, see if you can fill this in. I want to give you the first answer. What's that bottom row? Can you fill in the bottom row? Make sure you get that one right. So we've got a 1-year bond, initial current yield of 1%. The price of the bond, the par face value, is 100,000. All right, fill this in the bottom. This one is not affected because it's held to maturity. Then all of a sudden the interest rate doubles. Okay, so this one is the same, the 1-year bond. So for the 1-year bond, there's no capital gain or loss. And the rate of return is the same as the current yield. But how about the other bonds? See if you can fill that in. Yeah.
For the calculator, so is it interchangeable with this says coupon rate and interest rate? Like it says there's a rate of return at 1% coupon rate, but then the interest rates doubles from 1% to 2%. So if you're putting this into the calculator, does this go into the coupon rate?
Coupon rate is always the same, 1%.
Okay.
The interest rate is the yield to maturity.
Oh, okay. So you don't. Is there a way to calculate that?
Let's see. Put it down a little smaller so I can see it again. Current price, par value. It gives you current yield.
Yeah, I don't know if I can.
Oh, I don't know if you guys can do this, can you?
You might be able to calculate it.
I need to give you part of the answer probably. Yeah, you'd need to do this maybe with the... Okay, let me give you the first column, okay? So for the 1-year bond, we're okay, we're not affected. But at the end of the first year, the interest rate doubles. So this affects the price of all the other bonds because it changes their present value, right? If they haven't reached maturity. So this one, I think, would be hard for you to fill in. You could do it if you have Excel, but you can't do it with that MoneyChimp calculator.
This one too?
No, you
No.
can't do it with this one.
Oh,
Yeah,
okay.
yeah.
No wonder.
Yeah, you have to do it kind of longhand in a sense, which is why I'm giving you the price. Because to do it longhand for 30 years is going to be hard. Okay, so if I give you the price, because I think figuring out this price for a 30-year bond is kind of hard. I mean, not hard, but tedious. Okay? So if I give you this, you can fill these in really quick, right? That shouldn't be too hard. You can't use the MoneyChimp calculator for this. You guys are the most likely to get it. Okay, so what's the rate of capital gain for the 2-year bond? Do any of the rest of you know? This group knows. What's the rate of capital gain on the 2-year bond? Is it a gain or a loss? They're all losses, right? The first one is a 2% loss. How about the 30-year one? Did anybody figure out that one? Yes, 22%. It's like a 22% loss. All right, so what's the rate of return on that 30-year bond? For the 2-year one, yes. Yes, so for the 2-year one, the rate of return, if you round it up, it's minus 1%. How about for the 30-year one? What's the rate of return for the 30-year one? It is negative. It's negative. What? Mm-hmm.
What's the rate of return for
Negative 22 is the rate of capital gain.
23.
It's negative 21. Yes, but a little late. I've been waiting back there for 20 minutes. It's negative. Negative.
Oh my God,
All right, listen, I really, really, really want to do one more topic. I feel you're all worn out. Let's try. Just try. One more concept, okay?
Why do you lose money when your rate of return goes?
Okay, so you can do what Raina, sorry to pick on you, but you can do what she's suggesting, which is like, I'll just hold my bond, and then I won't lose any money. But you are losing money because
We're using the opportunity cost.
you're losing the opportunity cost of getting 2% instead of 1%.
So like when the interest rate goes up, your current value goes down, right? The present value goes down. That's why you get a loss. Am I right?
Yes. Your current value, present value goes down. I mean, it's the same thing, but do you guys get it?
So, but you still have a loss when your bond matures.
Yes.
You can avoid realizing the loss by holding on to it for 30 years.
And then when it
But-
matures and you cash it in,
Then you can cash it in.
then you're still losing money.
But for 29 out of those 30 years,
You lost money.
you were kind of losing money because you were losing the opportunity cost of investing at a double interest rate that doubled. Yeah.
And then the rate of returns go down, so then people start selling the bonds. Is
Yeah.
it possible that, like, because supply goes up rapidly, the price of the bonds go down even further, or is it not like that?
Well, that could happen. It would be irrational. And I don't know of research that's showing that the bond markets are irrational.
Okay.
Because everybody has like the money chimp or something better. They're all calculating that and they're watching it every second. So they're pretty rational. But yeah, it could happen. It could happen. I guess it does happen for like very short time periods. It does happen. It can go a little bit
Also,
below.
it's not exactly like a better way if you immediately sell it, even if you incur kind of a loss from changes in interest rates. Like, right now I was thinking, because you said there's a loss of opportunity cost if you hold it out until the completion of the maturity date. But then, so is it better even if you're making a loss at that present moment not to sell it off, or?
Oh, I see. Either way you made a loss.
Yeah.
Either way you made a loss. Yeah. Yeah, either way you made a loss. Okay, one last topic.
One interest rate.
One last topic, okay, that I want you to get before we go to the case study Friday, which is real versus nominal interest rates. Some of you may have learned this before, so I'll go quickly unless you have a lot of questions, okay? What's the real interest rate? All right, the real interest rate is like any real variable. It's been adjusted to remove the effects of inflation. You may have learned about real GDP, all right, in other classes. So it reflects, the real interest rate reflects the real cost of funds to the borrower and the real yield to the lender. Shh, I need you guys to be quiet. I'm going to stand right here. The real interest rate is adjusted for expected changes in the price level, which is the inflation rate. Okay? So you write it like this. The real interest rate is the nominal rate minus what we expect inflation would be. Okay? Or we usually, here, this is my next slide. Usually we calculate it, or we call it the ex ante real rate, because it's adjusted for what we expect or we think inflation will be. But you can calculate the ex post real rate. You can calculate in real terms the rate after you know what inflation is. Okay, ex post. All right, now I changed my slides here. All right, so in March 2013, the inflation rate reported for Japan, we were in deflation then. It was 0.9%. The 1-year nominal, what they call super takey interest rate offered at Citibank was 0.02%. It was very low. Okay? So what was the real interest rate, not you can get, that you could get in March 2013? Do you know? What is it? Can you figure it out? This is not hard. So either you're shy or tired. It's just the nominal rate minus the inflation rate. Is that what you had? 0.29%. 0.29. Okay. So when you have, this is the thing to remember, when you have deflation, why does it make no sense? Who said that?
That's it.
Why is,
Yeah.
why is
Point
it point?
0.0002 plus 0.009, right? Wouldn't that make it 0.0092?
Oh, maybe. That's what you said. So maybe that's right. Maybe it's 0.0092. Yeah. Okay. The point here is, though, that when we have deflation, which is not where we are anymore, all right, then actually the real interest rate,
It's higher than the retained interest rate.
nominal one, the nominal one. Yes, that's the point. Okay. All right, so what about now? We found that latest annual inflation rate was 1.5%. The latest number we have is February. Can somebody look up the Citibank super takey rate for 1 year now? What's the real interest rate now? Well, first let's find the nominal one. Then what's the real one? I can't really use my notes anymore here. So we'll call that the nominal rate. This is the inflation rate. And let's say we expect it to stay here, 1.5. Let's say we expect it to stay here. What might you, while people are looking up, did anybody find the Citibank rate?
For how many?
For 1 year.
0.01.
%0.01%? Okay. So it's even lower than it was last year. Okay, so what's the real interest rate? I don't know if I put it on the slide or not. Oh, I didn't. Okay, so what's the real interest rate? Can somebody write it up here? Would you come write it? Koji? Write out your steps. So,
Steps.
yeah, just write out everything that you're doing so people can see. Right. So the real interest rate is nominal minus the expected inflation rate. And while he's doing that, let me ask you, what's your expected inflation rate, let's say, over the next year? Does anybody have one? Am I being correct in using the February rate, 1.5? You think it'll go down? Why?
Because I think it was a temporary increase in price levels due to the boost in money supply. I don't think it's going to continue to be at that level.
Okay, so one person is skeptical because this is due to the QQE and it won't continue. Does anybody think it's going to go up? No? Okay, you guys don't think Abenomics will work? Oh, it's 3. I didn't get through my topic. Okay. So right now, let me just finish this. Let me just fit this in now. This is why actually you guys should be happier because Japan is strange right now. We're in unusual times. You actually, the present value of this 1 year from now may be higher than the value right now, today. Because we're in strange times. Because what's the real interest rate in Japan? It's negative. So if for the whole next year the inflation rate is higher than the nominal interest rate, you would rather I hold on to this and give it to you next year than give it to you now. But it's unusual, very strange situation, okay? So we'll have to just revisit this very briefly on Friday before we go and spend most of the class period on the case study. So read the case, think about it, and come with a good answer to, did they make the right decision in the case of Bayer, and why?
We should be buying Japanese JGBs or bonds of any sort.
Well, it depends. depends on what you think will happen to inflation and interest rates.